and a warm welcome to the AI with Arun Show. I want to start with a puzzle. Imagine you're running a marathon and you just broke the world record. What happens? You celebrate, right? But in the world of AI investing, something strange happened in late November 2025. Nvidia, the undisputed king of AI, released its fiscal third quarter earnings. The results were phenomenal. $57 billion in revenue, a stunning 62.5% increase year over year. They beat expectations, they raised guidance. It was a perfect report. And yet, the stock market sold off sharply. The S&P 500 fell 1.6% and the Nasdaq dropped 2.2%. This is the great divergence. Why did perfection cause panic? Our goal in this video is to answer that question. We are moving away from hype and towards forensic scrutiny. We need to determine if the AI supercycle is a justified boom or a massive financial imbalance waiting to correct. The market has shifted from simply buying every AI stock to answering one tough question. Where is the return on investment, the ROI? The anxiety has split the AI world into two. One, the picks and shovels layer. This is the infrastructure companies like Nvidia, the data centers, and the energy providers. They are posting record fundamentals and the market has priced in their perfection. The second, the application layer. This is the software meant to use those chips. They are suffering from what analysts call the pilot purgatory. Companies doing trials that never turn into big paid contracts. They show high customer churn and low pricing power. This leads us to our core diagnosis. We are likely in a Capex bubble. This is not a failure of the technology, but a scenario where the infrastructure supply has been built so fast, it has created a temporary vacuum of demand. And to put this in perspective, as of November 2025, the overall market measured by the CAPE ratio is trading at levels that surpass the peaks of 1929 and 2021. We're only trailing the extreme exuberance of the 2000 dot-com bubble. We are pricing in perfect outcomes. Now let's spend just a minute talking about what CAPE means. The CAPE ratio is a way to check if the stock market is expensive or cheap compared to the past. It looks at prices today versus the average company profits over the last 10 years, adjusted for inflation instead of just 1 year. A high CAPE ratio means stocks are expensive versus the long-term earnings, so future long-term returns may be lower. A low CAPE ratio means stocks are cheap versus long-term earnings, so future long-term returns may be higher. To understand where we might be heading, let's look back 25 years to the original internet boom and the story of Cisco systems. Cisco was the Nvidia of 2000. They built the essential plumbing, the routers and the switches that formed the internet backbone. Their thesis was flawless. Internet traffic was exploding and every byte needed a Cisco router. In March 2000, Cisco briefly became the most valuable company on earth, trading at a forward price to earnings ratio of 201x. When the dot-com bubble burst, Cisco's stock collapsed by 80%, and despite the internet succeeding wildly, it took over 2 decades for the stock to recover. Now let's compare that to Nvidia in 2025. Nvidia's current valuation, around 40.18 times forward PE, is much more grounded than Cisco's 201x peak. Nvidia also has significantly stronger profitability, boasting huge 73.6% gross margins. But here is the critical risk: the quality of earnings. Cisco's revenue was inflated by lending money to startups to buy its equipment, vendor financing. Today's Nvidia's revenue is heavily dependent on two groups: hyperscalers like Microsoft and Google, engaged in an arms race, and AI startups funded by venture capital. If those buyers can't generate ROI, Nvidia's massive order book could disappear overnight, just like Cisco's did. The core reason for this Capex bubble hypothesis is the sheer breathtaking scale of the spending by big tech, the hyperscalers. They are caught in a prisoner's dilemma. If one of them stops spending, they risk being obsolete. So they all spend aggressively. The numbers are staggering. Goldman Sachs estimate that the hyperscalers, Microsoft, Google, Amazon, and Meta, will spend a combined $1.15 trillion between 2025 and 2027. That is more than double what they spent in the previous 3 years. To put that massive figure into human context, the entire Apollo space program cost about $150 billion in today's dollars. The tech industry is spending roughly the equivalent of 4 Apollo programs every single year on AI infrastructure. This money is not just for chips, it's funding three areas: new GPUs and custom silicon, massive data centers, and critically, energy infrastructure, nuclear, geothermal, and grid modernization. For my viewers, the Apollo program was a human spaceflight initiative by NASA that landed the first humans on the moon between 1969 and 1972. And many of you know that there was a historic achievement in space exploration at that point of time and even today. When you are spending trillions of dollars, corporate boards get nervous. That is why the industry has developed a way to make the risk sound smaller. David Kahn of Sequoia Capital noted a shift. Instead of talking about dollars, value is being measured in gigawatts. For example, they don't say we are building a $1 billion facility. They say we are building a 100 megawatt facility. By substituting dollars with power units, the gigawatt currency, the financial risk is abstracted. It helps corporate boards approve spending that might otherwise look reckless. The circularity, where the unit of account detaches from economic utility, is a classic warning sign of speculation. The constraint on this supercycle is no longer capital, it is physics, the availability of power. This dynamic creates a severe risk we call the stranding risk. Data centers, the building, are long lived assets lasting 20 to 30 years, but the chips inside them, the Nvidia GPUs, become obsolete in 3 to 4 years. If the demand for AI model slows down, the hundreds of billions spent on the silicon could be effectively written down to zero. That is why some investors are rotating capital forward towards utilities and real estate, betting that the steel in the ground is safer than the chips themselves. This is the most crucial picture that you are seeing on the screen right now. Now, this is the math problem that justifies the market panic, which is the $600 billion question. The central tension is simple. The cost of infrastructure far outweighs the revenue it's currently generating. By late 2025, the gap between AI spending and realized revenue has widened to an estimated $600 billion. Let's walk through the math simply, based on the 100 billion annual hardware run rate from Nvidia. So the hardware cost is 100 billion in chips. The total cost of ownerships, the TCO. Now chips are only half the story. You must account for energy, you must account for cooling, for networking, and the building. This doubles the cost, requiring $200 billion in infrastructure spending. Let's talk about margin requirements. For any business like Microsoft or an AI startup, whatever the company might be, to run profitably, they need to target a 50% gross margin. This means they must generate twice their operating costs. So, what is the required revenue? The required revenue is 200 billion infrastructure cost times 2, which is $400 billion in needed annual revenue. Accounting for accelerated spending pushes this figure towards $600 billion. Against this required revenue of $400 billion to $600 billion, how much incremental AI revenue is the industry actually generating? Analysts estimate only 50 to 80 billion. Now, this immense gap is the capital efficiency crisis. Viewers, you may want to pause this video and rewind it to make sure that you understand this, because this is the crux of the matter. So, who is actually bridging the $600 billion gap? The latest earnings season showed a clear hierarchy of execution. Microsoft, the leader. Microsoft provided the strongest counterargument to the bubble thesis. Their Azure cloud revenue grew 33% year over year. Crucially, they quantified the AI contribution. 16 percentage points of that growth came directly from AI services. That is build verifiable revenue, not speculation. Furthermore, Microsoft stated they are still capacity constrained, meaning demand for their AI services exceeds the hardware they can currently deploy. Then Google, the full stack. Google Cloud grew 34% year over year, actually outpacing both AWS and Microsoft in percentage points. Google also confirmed that they are seeing billions of dollars per quarter in AI revenue. Their success validates the full stack thesis because Google designs its own custom chips, TPUs, and controls the entire infrastructure. They can potentially achieve higher margins by controlling costs better than competitors who rely purely on outside vendors. Then let's talk about Amazon AWS. AWS is still the market share leader, but its growth rate is slipping, growing only 20% in Q3 of 2025. The narrative around AWS is that they are struggling to transition from being a dump pipe, a basic utility service, to the intelligent cloud that offers deep AI platforms. They lack a killer app like Microsoft's Copilot to drive massive new consumption. All right, so let's return to Nvidia, the single most important company in this ecosystem. Despite massive revenue, two critical warning signs emerged in their November 2025 report. First, the inventory warning. Forensic analysis showed that Nvidia's inventory turnover days rose from 103 days up from 91 days in the previous quarter. So, the inventory turnover ratio now, or the inventory turnover days, is now 103 days, up from 91 days in the previous quarter. In the chip world, when growth is phenomenal but inventory is building up, it often signals that the customers, the hyperscalers, are pausing to digest their previous purchases. If this trend continues, it's a classic sign of a semiconductor cycle top. Second, the custom silicon, the ASIC threat. NVIDIA's biggest customers are also becoming its biggest competitors. Google is deploying TPUs, tensor processing units. Amazon is pushing Trainium. Microsoft is ramping up on its Maya accelerator. They are building these custom chips to offload standard AI tasks like inference, which is cheaper to run on custom silicon than on expensive NVIDIA GPUs. While NVIDIA has a formidable moat in its CUDA software ecosystem, this structural shift means that in the long run, hyperscalers will demand lower prices, threatening NVIDIA's incredible 73.6% gross margins. The private markets, venture capital, tell us what's coming next. The story here is one of extremes. First, the feast of mega rounds. Now, capital is not drying up, it's concentrating at the very top. In Q3 2025, over 30% of global VC funding went to massive deals exceeding $500 million, such as Anthropic raising 13 billion and XAI securing $10 billion. Now, these are effectively nation state levels of capital needed to compete in the foundational model race. Second, the famine below the surface. Analysts are predicting an extinction level event for early stage AI startups. Reports suggest that up to 99% of current AI startups could fail by 2026. Why? The lack of moats. Many startups are just wrappers, thin user interface built on top of OpenAI or Google's APIs. When the foundation model providers releases a native feature, like a built-in PDF analyzer, the startup's entire business model is obliterated overnight. Then poor unit economics. Unlike traditional software, AI startups have a high cost of goods sold because they pay inference cost for every single user interaction. There is a funding drought. Seed stage funding in North America shrank 25% quarter over quarter because investors are refusing to fund features disguised as companies. The ultimate success of this entire 1.15 trillion build out rests on one factor. Will large enterprises actually buy the software? Right now, the answer is maybe later, leading to the pilot purgatory. Gartner suggests a staggering statistic. At least 30% of generative AI projects will be abandoned after the proof of concept stage by the end of 2025. So, why are projects failing? Because bad of data. Companies find their internal data is too messy and too siloed for AI to be effective. Then there is trust and accuracy. 44% of manufacturing leaders cite accuracy risks or hallucinations as a barrier. Then there is an elusive ROI. It's hard to translate productivity, like writing emails faster, into hard dollar savings, like headcount reduction. Now, this is also causing a breakdown in the traditional software business model. If you charge per seat, let's say $30 a month per employee, and the AI makes your customers so efficient, they reduce their staff, you lose revenue. The business model creates a perverse incentive. The industry is responding by shifting to volatile usage based pricing, charging per token consumed, or outcome based pricing, charging per support ticket resolved. Now, while this is fairer, it creates uncertainty, and investors hate uncertainty, which generally compresses software valuation multiples. So, where do we land? Is this a dot-com style bubble? Our analysis suggests that no, it's not a tech bubble like 2000. The underlying technology works, it is transformative, and it is generating billions in verified revenue for companies like Microsoft and Google. So, the utility is real. However, we're almost certainly in a infrastructure capex bubble. The level of spending, the $600 billion projected need, is fundamentally disconnected from the current $50 to $80 billion revenue reality. The problem is timeline disconnect. The timeline for capital deployment, buying chips, is far faster than the timeline for enterprise adoption and ROI realization. This suggests a painful correction is coming for the hardware supply chain as hyperscalers pause to let revenue catch up to capacity. One structural factor acts as a buffer against a total collapse, which is sovereign AI. The governments worldwide are treating AI infrastructure as a national security matter. Countries like Saudi Arabia, France, and Japan will continue to buy GPUs regardless of commercial profitability, setting a floor for demand. We are at a key inflection point. The easy money phase is over. The infrastructure super cycle has successfully built the railroad tracks, but now the market must ruthlessly filter for the trains, the businesses that can run on them profitably. We see three possible paths for 2026. The digestion phase, most likely. Hyperscalers slow down their capex growth to absorb the capacity they have built. Nvidia stock correct 20 to 30% as the hypergrowth narrative cools. Crucially, we see a mass extinction of 50 to 70% of AI startups. The market rotates to quality AI, companies with clear P&L proof. Scenario number two is the productivity boom, which is the bull case. Enterprise quickly overcome the pilot purgatory. AI agents rapidly replace labor at scale, causing revenue to explode. The $600 billion revenue gap closes, justifying all the capex, and the supercycle continues. And scenario three, the fiber crash, which is the bear case. A recession hits. Enterprises cut IT spend, data center utilization rates remain low, hyperscalers are forced to write down billions in assets, forcing Nvidia to collapse 60 to 70%, triggering an AI winter before a slow recovery. What is the final verdict? The bubble we are experiencing is one of expectations of immediacy, not a bubble in the reality of the technology itself. High volatility and consolidations are guaranteed as the market matures. What is your thought? What do you think is the most likely scenario for next year and beyond? Let us know in the comments below. And with that, we come to the end of the show. Support our work by joining us as a member. All you have to do is go to the description, and at the very bottom, you'll find the link for becoming a member. And thank you so much for watching. If you like this video, please like, share, and subscribe to the AI with Arun Show. Thank you for watching.